welcome back to the 50-Day Property Challenge, brought to you by the EDPF Property Academy and Private Property. It is day 30, and we've asked our challengers to watch this video we've created on property investment fundamentals while going out in search of their very first property in this challenge. Enjoy session 1 as we teach you all about why property is a good investment.
Hello all friends of the Enterprise Development Property Fund. I am Nigel, your host, and for the next few weeks we'll be talking about property investment fundamentals. In this series, we will teach you everything you need to know to start your property journey. Today, we want to talk about your why. What do I mean by that? What is your why? What is the reason for you wanting to start your property portfolio? For some people, the why would be to build a legacy. That is my personal reason. For some people, it will be just to earn enough income to survive. For others, it will be to build a big asset base so that they can retire early or retire at a later stage but leave something for their family. Your why could be any one of these reasons and much, much more. You could have any other reason, but you need to have a why. Why do I say that? Because if you don't have a why, if you don't have a reason for wanting to do this, then you are not going to be able to sustain yourself. I was asked this question the other day by one of our candidates to say, what keeps you motivated? This is the very thing that keeps me motivated and will most likely keep you motivated. The why, the reason behind you wanting to do and run your property portfolio. So the first thing you need to decide for yourself is why. Consider this very, very carefully. It must be that thing that's going to drive you, that's going to push you when people continue to tell you that what you're doing is a waste of time. When people continue to tell you that what you are doing is not going to end up as you think it's going to. When people keep telling you that this thing is going to lose a lot of money. When people keep telling you that this thing is going to destroy your life. You need to have that why. Because that's the thing that's going to help you to wake up in the morning and be motivated to carry on. The next thing we want to talk about is why property. You could use your money for any other investment. You could put the money in the stock exchange. You could put the money into any other investment opportunity. We want to talk about property as an investment opportunity because this academy, the Enterprise Development Property Fund, is all about property. So we want to talk about why property. A few years ago, I invested some money into a retirement annuity. At the time, I had 124,000 rand in this retirement annuity. I stopped investing in this retirement annuity in the year 2004 because I quit my job and I decided to start my own business. That business ultimately failed, but the story still holds true. So in 2004, I had 124,000 rand sitting in this retirement annuity. 2 years ago, I got a statement about this retirement annuity because, as you may or may not know, you cannot take money out of a retirement annuity until the age of 55. So because I'm not 55 yet, I cannot take the money out. So 2 years ago, I get the statement, and the company that I had invested my retirement annuity with had the goal to tell me that they were pleased to announce that I had grown this portfolio from 124,000 to 132,000 rand. Imagine that, 8,000 rand growth between 2004 and 2018. We're talking 14 years for 8,000 rand additional to the 124,000 that I put in so many years ago. Now, if you look at that and you say, what is the percentage return on my investment? It is less than 1% per year. And in fact, if you take inflation into account, we are talking negative 5% every single year of growth. Now, if I had taken that money, and if I had been wise back then, and instead of putting my money into a retirement annuity, if I had taken just 100,000 Rand of that money and used the rest for shoes, I would have been able to take that 100,000 Rand, go to the bank and say, give me a bond of 900,000 Rand, making it R1,000,000. I could then take this R1,000,000 and purchase 1 or 2 properties at the time. I could have bought 2 500,000 Rand properties and probably at that time receive an income of about 10,000 Rand of rental per month. Now, obviously, I would have expenses. I'd have my bond to repay. I'd have rates to repay. I'd have levies possibly if it's in an apartment block. But knowing myself, I would have probably taken all of my extra cash and put it into this investment. By 2018, the time that I got the statement, my bond would have been paid up. The value of the property would have probably been in the region of 1.5 to 2 million Rand. And number 3, my rental income would have grown to probably between 15 and 20,000 a month. Now just think about that for a second. In all this time, I got 8,000 Rand from this retirement annuity. But now after 14 years, I would have been able to have paid up my bond. My asset would have grown to about 1.5 to 2 million Rand. And I would have received on a monthly basis 15 to 20,000 Rand a month in income. Now, isn't that a lot better than putting your money into a retirement annuity? So, why property? Because number 1, it gives you the ability to grow your asset base much more rapidly than any other investment. Number 2, once you've paid up your bond, you've got free cash flow. Free cash flow to do with what you like. But normally what I would do is to take that money and instead of spending it, reinvest. Because with that reinvestment, not only is my initial investment growing, I can then buy more property with the money that I'm making. And therefore grow my portfolio of properties much more rapidly by using the income that I'm getting. So instead of taking the money out and using it on my monthly expenses, I can use that money to grow my property portfolio. Now, isn't that a phenomenal way of utilizing your capital? So, in this series, we're going to talk about a couple of things. The first thing that I want you as a first-time investor to think about is to know what you're getting yourself into. As much as some people would like to tell you that property is an easy thing to invest in, let me tell you right now, it is not. If you want to be a property investor, you need to be committed to this investment. You need to know that you are going to have to spend time and money in order to grow your portfolio. You need to look after your building from a maintenance perspective. You need to make sure that it's always full, that your tenants are paying rental, that rental isn't being wasted, that you're using it, number 1, to pay your bond, number 2, to pay your other expenses, and if there's any additional cash flow coming from that property, to not use it for your personal expenses, but to rather use it to grow your property portfolio. You need to, number 1, know what you're getting yourself into. The next thing is to consider yourself a business owner. As a property investor, you are not somebody who's buying a house to live in so that you can enjoy it personally. No, you are a business owner. Think of the property as a commodity, something that you can use to earn an income from. Most multimillionaires and most billionaires in the world have a property portfolio that they are generating passive income from. What is passive income? Passive income is money that you are generating from an asset that you don't have to put much effort into. Now, I say not much effort because you are going to have to put in some effort. And depending on how quickly you want to grow your portfolio, that will determine the amount of effort you have to put in. On the one hand, in terms of the amount of investments you have to put in, the cash that you have to find either out of your own pocket, from the banks, from other investors, or any other way that you decide to raise your capital. That's the one side. The other side is how much of the income that you are receiving are you willing to put back into the business and not spend on your own personal expenditure? So that is a very important aspect, considering yourself a business owner. This is a business. It's not something that is fleeting. It's not something that you are going to use as your personal bank account. It is a business. And as such, you need to treat it as a legal entity on its own. That this is not, like I said, your own personal bank account. This is a business that is going to generate income, has its own expenses, and grows in asset value. We will talk more about this this investment, this opportunity, this portfolio as a business at a later stage. The next thing is to make sure that you understand the costs. There are several costs related to property. Number one, and the most important and first thing that you're going to have to spend, is the purchase of the property itself. So understanding what that cost is all about, it's not just the price of the property. If you buy a property for under R1 million, there's no such thing as transfer duty in our laws today. This number may grow at some later stage. Every year, the receiver of revenue increases that number. But in today's terms, in 2020, if you buy a property for under R1 million, you do not pay transfer duty. However, there are other costs. There are legal costs. There are the legal costs related to the transfer. There are legal costs related to the bond, and many other costs. There's rates clearances, which in most cases the seller will pay. There's electricity, getting the electricity certificate, electrical certificate. Again, most times that is paid for by the seller. However, in some cases, the seller would insist that you as the buyer pay those costs. The legal fees and the bond cost, at very least, are the costs that you need to cover. So if you buy a property of R1 million, chances are the property isn't only going to cost you R1 million, it's going to cost you anywhere between 1,050,000 and 1.1 million, 1,050,000 and 1.1 million rand. That's roughly the range of which it's going to cost you, the buyer. So that's the first batch of costs that you need to consider. The next batch of costs that you need to consider are the running costs of the property. If you are receiving no rental income, you have to pay the bond out of your own pocket. You have to pay the maintenance costs. You have to pay the rates and taxes. You have to pay the water and electricity. You have to pay the gardening costs. And if it's a big enough building, you have to also pay for security and cleaning. So there's a whole bunch of costs, operational costs, that you have to look at and consider whenever you buy a property. Now, if you have a tenant in your building, chances are that the bulk of the expenses are paid for within the rental. Most likely, your bond is paid. Most likely, your levies are paid. And you can insist that your tenant pays all the operational costs, like your electricity usage, water usage, the cleaning of the garden, etc. So there's a whole range of things that you can charge your tenant for, over and above the rent itself. Then you can reduce all of your costs so that you only pay a small amount of money over in order to maintain your property. Hopefully, and if you negotiate well with your seller, you can build all of those costs into the rental. And because if you reduce the price of the price of the purchase of the property, your bond is then reduced. And because your bond is reduced, there's a very good chance that you could be cash flow positive. Now, we'll talk a lot about cash flow and about income at a later stage, but suffice it to say, at this point, the important thing that you need to remember is there's a big difference between cash flow and net income. And that big difference is the capital repayment on your bond. Because your bond capital repayment does not get factored in when you work out your net profit. It only gets factored in when you work out your net cash flow. But we'll talk a little bit more about that at a later stage. The next thing you need to consider is location. Location Location is one of the most important aspects in a property purchase. When you buy a property, make sure that you are buying a property that's in demand, either from a rental perspective or from a seller's perspective. Because if you purchase a property that is not in demand for the reason or the purpose that you bought that property for, then you are going to fall foul of your profits. Number one, if you're buying a property so that you can flip it, and by flipping what I mean is that you fix it up, you buy derelict property, you fix it, and then you sell it at market rate. So you buy it cheap, you put in some effort, and then you sell it at market rate, and hopefully there's a bit of a margin in between for you to make some profit. On the other hand, if you're buying it for rental purposes, then obviously you're going to hold the asset, it's going to stay in your name, or in the company's name, or in the trust's name, and we'll talk about structuring later, and then you rent it out for a monthly income. And hopefully, if you negotiate well, that monthly income will mean a positive cash flow on a monthly basis. That you personally do not have to take money out of your pocket in order to cover the expenses on a month-to-month basis. That is very important in this entire course. The main thing that you need to consider in running your numbers when you purchase a property is that you are not going to take money out of your pocket in order to cover the costs. Remember that, and we'll talk again a bit more about that at a later stage. The next thing you need to know is understanding your tenants. You need to understand the type of tenant that you're going to put into your property. The type of tenant will determine whether you are actually going to become profitable or not. The type of tenant will determine whether you're going to end up in court or not. So when you purchase that property and you start renting it out, you need to vet your tenants very, very carefully. You need to be sure that they are creditworthy. You need to be sure that their history of tenancies are not a negative history, that they have not defaulted on their rentals with previous landlords. And number three, you need to feel comfortable with that tenant. You need to feel that that tenant is going to look after your property and is going to pay their rent. So understand your tenants. Then be prepared to get your hands dirty. If you want to run a successful property portfolio, you cannot sit back passively and let other people do the work for you. You need to be willing to get your hands dirty. Get in the mud. Get in there in order to, number one, cut costs. Number two, in order to look after your portfolio. And that for me is the most important. If you get your hands dirty and you get in there and actually are part of the running and the management and the maintenance of your portfolio, then you will be successful. Not only because you are there looking after your own property, but number two, you are cutting costs by not employing other people to do that dirty work that you are willing to do. The more you are willing to get your hands dirty, the higher your profit margin will be. Then finding the potential where others see problems. There's a great saying in the property industry that goes something like this. You need to buy low and sell high. All right? Very important. Buy low and sell high. Then always buy under market value. You need to look for those properties. Like they always say in the industry, go look for the worst house on the best street in the best community. What does that do for you? If you're buying the worst house, you can pick it up for under market value, right? Because all the other houses who are selling for 2 million rand in that area are already fixed. They already have modern finishes, and their value is higher because they have already the owner has already done a whole lot of work. So what you want to do is to find that one house that is the worst on the street, because that gives you the opportunity to go and fix up, increase the value to what's around you, and then sell at market value. You can negotiate with the seller when their property is the worst on the street. But you cannot negotiate with the seller if their house is the best on the street. Unless, of course, that seller is in default with their bond, they want to emigrate, or they are looking for another property, they've already bought another property and they're desperate to sell. So either you need to look at a property that is in bad shape, or you need to look at a seller that is desperate to sell in order to get your property under market value. It is only when you buy your property under market value that you are going to make money in this game. My friend Andrew Walker from Sapin always says, when you buy a property, you need to make money when you buy, not make money when you sell. And by that we mean you make your money by buying your property for less than market value, so that when you sell, you can make some profit. But you make the money up front already when you negotiate with your seller. The last thing is to know your strategy. We'll talk a lot about strategy throughout this course, but you need to know your strategy and you need to stick to it. Because if you flip-flop from one strategy to another, I guarantee you are going to fail. It's like any other business. Any business you're in, if you go from retail into residential, into commercial, into industrial, your investors are going to lose confidence in you. And let's face it, none of us have the ability to run a property portfolio on our own. We need investors. Either we need the banks, or we need private investors, or we need both. In order to grow your portfolio, you're going to need other people's money. That is the only way you're going to be able to grow your portfolio, by using other people's money. If you want to grow your portfolio rapidly, you need other people's money. And in order to get other people's money, you need to have a clear strategy. You need to say, I'm going to be involved in residential developments, and that's what I do. Or I'm going to be involved in student accommodation, and that's what I do. But again, we'll talk about strategy at a later stage. Okay, so you're a first-time investor. The first thing you need to have is patience. You need to be patient, because if you are impatient, you will make stupid mistakes. If you are impatient, you are going to lose money. If you are impatient, you are going to do the wrong things, choose the wrong properties, choose the wrong strategy, etc., etc. Now, a lot of guys will get involved in the property sector, and they will do what they call flipping. I spoke about that a few seconds ago. Now, if you're in the flipping game, then you can make money quite quickly. However, it's the riskiest of all of the investment strategies, because what will happen is you buy a property, you fix it up, you bought it for $1 million, you spent another 200,000, the market value is now 1.5 million, and you put it on the market, and then COVID hits and there's a lockdown. Now you're stuck with this property for the next year before the markets turn again, and you haven't found a tenant, which then means that you need to pay the bond. You need to pay all the expenses, etc., etc. So you need patience, and you need to know that within your strategy, there are going to be times when things just aren't going to go your way, where you're just not going to make the money that you think you're going to make. So you need to be patient. My strategy is long term. My strategy is going from buying a building to renting it and holding it for at least 10 years before I even think of selling. Because that is where you get your real profit from. Not the rental income that you're making on a monthly basis, but that capital growth for those 10 years that you have allowed the property to sit and be patient. Location we've spoken about. Location is very, very important. If you choose the right location, you will make good money. You need to consider rental income versus capital growth. Is your strategy going to be for a quick turnaround, or is it for a long-term period? Which in that case, you will not only get the capital growth, but you'll also get that monthly rental income. And every year, there's an escalation. Every year, you will escalate anywhere between 6 and 15% depending on the market you are in. So not only do you have your rental income, you've got growth on that rental income, but you've also got growth on the capital value of your asset if you wait long term. All right, snag lists, structure, sewerage, plumbing, electricity. These are all things you need to consider when you buy a property. You need to know that when you go and purchase a property, it's not just about where, it's not just about the value, it's not just about whether you can rent it or sell it, but it's also about the internal structures. So you need to do your due diligence. You need to make sure that what you are buying is what you are buying. When you look at a building, it is easy to hide the problems that sit behind the building. It's easy to hide the plumbing problems. It's easy to hide the sewage problems. It's easy to hide structural problems as a seller. So you need to assure yourself that what you are buying is what you are buying. Bring in the professionals to look at that building. I promise you, it is going to end up being cheaper to spend that money up front by bringing in the professionals than it's going to cost you if you find there's a structural problem and your house is sinking into the ground. Rather be sure that your building is structurally sound before you sign on the dotted line. Then we're talking about maintenance. Maintenance is something you need to always bear in mind. If you want your portfolio to grow in value, if you want that capital asset value to grow, you need to maintain your property very carefully. Now, in bigger corporates, they normally say 3% of your value, your asset value, has to be held back in your income in order to maintain your property. But in smaller portfolios, you need a much higher percentage. I would recommend roughly about 10% of your income has to be held back in order to build a slush fund that's going to help maintain your property so that you can get the growth. You cannot get property value growth if you're allowing your property to fall into ruin. If you do not maintain your property, I guarantee you, you are not going to see the value accretion that you hope for. Then diversification. Once you start growing your portfolio, it is better to diversify your portfolio into different asset classes, because if one asset class is not gaining in value, I almost guarantee you that the other asset class will. So let's take the JSE as a classic example, or any other stock exchange during the COVID lockdown period. During the lockdown, the stocks, in fact, some of the only stocks that were making money and growing in value were tech stocks. Why? Because everybody was working from home. Everybody needed a new laptop. Everybody needed Zoom and all these webinar systems in order to talk to one another, because you couldn't go into the office anymore. However, now that we are in a phase now at the end of 2020 where things are changing, there are a couple of vaccines that have come to the fore. All of a sudden, the tech stocks are dropping. However, what is increasing? The value of shares in things like oil and gas. Why? Because now people are going to be back on the road again, and they're going to drive their cars again. So people are going to buy petrol and diesel and so on, and therefore oil and gas prices are now increasing again. The value of those assets are increasing. During this lockdown period, the only people in property that were making money were people who had residential units. And even they were struggling because people couldn't afford to pay their rent. And on top of that, you couldn't evict anybody because the government wouldn't allow you to. However, people who were in retail and in commercial office and industrial were suffering because their tenants weren't working from the office anymore. And the tenants were going, I can't afford to pay your rent. So you need to diversify your portfolio so that if anything goes wrong in the one area, that the other area is still making money, so that you balance out your losses when the tough times come. And you need to read the markets. You need to be able to say, today the residential market may be strong, but tomorrow student accommodation is going to be strong. You need to learn to read the markets. All right. Then you need to remember affordability. Affordability is very important, not just for your own sake, but also for the sake of the banks and any other funders. No funder, especially the banks, no funder will lend you money to buy a property unless it's affordable. So if you're buying a property of R1 million and your net income is less than 10,000 a month, then you're not going to be able to pay your bond because the bond is going to be 10,000 Rand. So your cash flow is going to have to be able to accommodate not just the bond, but other expenses as well. So you need to know that when you buy a property, that it is affordable to do so. Okay. Now let's talk about the discussion points that we are going to have over the next couple of sessions. You're a first-time investor, and there's a lot of things that you need to know. So the first thing we're going to teach you is the principles of financial freedom. The next thing is going to be successful property investing. Then we'll talk strategy, the area in which you're going to invest, the property, and financing of that property. We're going to talk about income versus cash flow. We're going to teach you all the financial metrics that you need to understand in order to make a wise investment decision. We're going to teach you all the deal analytic tools that you're going to need in order to find good deals and to analyze those good deals. We're going to talk about protecting your wealth, because it's all good and well to make money, and it's easy to make money. What's more difficult is to hold on to that wealth and hold on to that money for the long term. I can tell you many stories of my own stories, other people's stories, where millions have been made and sometimes even billions have been made and lost very quickly because people do not know how to manage their wealth. So we're going to teach you about wealth management. We're going to teach you about property as a business. We're going to teach you why you should run your property portfolio as a business, and we're going to hopefully be able to teach you how. And then the last thing we're going to talk about in the series is about taking action. One of the key fundamental aspects of being a property investor, or any other investor for that matter, is taking serious action. It's all good and well to learn everything that you need to learn. I know a lot of people who have done many courses, whether it be online courses and whether it be face-to-face courses, even people in my very own incubator here at the Enterprise Development Property Fund, where they've learned everything they need to learn. They've been given plenty of deals. They've analyzed hundreds of opportunities. But before you take that leap and take action, you are never going to be successful. That is the most critical stage. You cannot analyze deals until they are dead. You need to take action at some point. Taking action is the most critical part. For session 1, we're going to end here, and we will talk about all of these topics individually over the next couple of sessions with you. So this is Nigel signing out for session 1 of the Property Investment Fundamentals course.
Thank you for joining us on this, the 13th day of our 50-day property challenge. Watch us again tomorrow as we continue this journey with Matt L. and Jared Dickens.